Good afternoon, everyone. Robert Reaburn here from Life Pro Asset Management. Hope that everyone's having a great week so far as we start off the month of August. And as usual, if anyone has any questions or concerns, just feel free to reach out to our office at 888-543-3776. You can also reach me directly on my mobile phone at 858-354-5114 if anyone has any questions specifically as it pertains to their portfolios or the individual investments within those portfolios. Definitely feel free to give me a call. That's what we're here for. So let's go ahead and get started. The theme of this week is investing with conviction, and that's often easier said than done, of course. But what we really try to do here at Life Pro is use data to really drive what we're doing with client portfolios over the long term. And the more effectively that we can drown out emotion, drown out noise, especially that short-term noise that constantly bombards us from the 24/7 news media cycle, we're going to do a pretty good job of staying focused on investing in individual businesses that are going from good to great, are good getting better, and are able to deliver earnings growth and by proxy expand their enterprise value over time so that we deliver those results to clients. So this week we're really going to take a step back and try to focus on what really matters. And when we look at the market today, skepticism, liquidity, and increasingly falling correlations are really starting to support what we do here at Life Pro, which is an active approach to investing. So this week we're going to go over stock correlations, what they're doing, what that means for your portfolio, overall investor positioning, and how that historically has impacted the stock market. And then lastly, we're going to do a quick review over the volatility market, how much liquidity there is in the system, and what impact that's having on the overall credit markets, and by proxy, the stability of the overall capital markets, which includes, of course, the stock market and an impact on our portfolios. Now, in terms of performance, overall, we continue to have a decent year here in 2020. As of August 3rd, we're up just around 54.85%. As of the time of this recording, I believe we're up around 1 or 1.2%. So that should take us into just over 56% year to date. So we've been able to deliver just around 53% of outperformance versus the S&P 500. We know that our management fees are a little bit higher than Vanguard's, for example. But at the end of the day, if you're paying 1% versus 0.3 or 0.4% over at Vanguard, the question is, are you getting 0.6% of incremental value? And we believe the answer to that is absolutely yes this year, because if you were invested in a Vanguard index product, your return would be in and around this 1.98% number, give or take a couple percentage points depending on the specific index you're invested in. So this year, up just around 55% after fees. Since inception, so January 1st, 2017, we're up just around 152.33%, being able to deliver outperformance of 105.17%. So definitely happy with those numbers. But again, as we say every week, for both our existing clients and our new clients, we want to make sure that from this day forward, that the forward potential returns are still attractive. And when we look at the overall market today, the bottom line message is that this reminds us of 2009. So for those investors that did not invest for the first 4 months of the 2009 recovery and started investing on August 1st, their 5-year return was over 110% after fees. So the bottom line message here is that now is the time to act. Now is the time to invest, increase your contributions. Liquidity is on our side. Valuations remain reasonable, and we're still in the first or second inning of this early recovery cycle. Now, in terms of correlations, typically what happens is during a panic or during the latter stages of a bull market, everything just goes up together. In other words, there's no discrimination between good companies or bad companies. In that exuberant stage of a bull market, everything goes up. The bad companies go up, the good companies go up, the mediocre companies go up. Everything just goes up together. And the same holds true during panic stages. So we saw in the first 2 weeks of March, it didn't matter if you owned Zoom or Carnival, they both went down together. But once stability returns to the system, which is really what the Fed did this year, is they put stability into the system, you're then able to see discrimination return to the market. And when we get falling correlations, what that really means is that if you're in an index product, you're probably sacrificing 60 to 70% of the overall overall potential that your portfolio has, because within an index, there's only going to be around 20 to 30% of companies that are driving 70 to 80% of the index return. In other words, you're voluntarily exposing your money to companies that don't deserve your capital. When we see falling correlations like this, stock picking, even though we think stock picking is always critical, it's even more critical as correlations fall, because the market starts to separate the winners and the losers. And we just have to look at, right now, if we're looking at the airliners, the cruise liners, the department stores, those types of stocks are sitting near 52-week lows right now, while other stocks more related to software and online commerce and e-commerce, and these types of companies are near 52-week highs. And so there's clear divergence, and it matters where you're positioned within the stock market. And that, by the way, what's driving our performance here year to date. In terms of overall S&P 500 positioning, nothing has changed. The only thing that we can really say is that investors remain net short, although a little bit less net short than they were obviously during March and April. But the fact that investors right now remain net short, as we see here within the blue circle, is incredible when we think that the market off the bottom has rallied so much. And that just is very emblematic of the amount of skepticism that continues to dominate the psyche of the average investor within the United States and overseas in Europe, China, and up north there in Canada as well. So as long as investors are net short, as long as skepticism reigns supreme, that is a bullish scenario if you're invested in stocks, because bull markets tend to die of irrational exuberance, and we're not seeing anything close to that right now. And in fact, we see the same thing over on the Nasdaq. Yes, investors are net long, but nothing close to the net long exposure that we saw in 2011, 2012, or even in early 2016 or mid 2016. So overall, again, very timid positioning on the Nasdaq and downright net short over on the S&P 500. So when the crowd's going one way, you want to go the other way. That is where opportunity presents itself. The other thing we wanted to bring up here is not fighting the Fed. Now, this is kind of a tricky thing to talk about, because a lot of people say, well, the market's only going up because of the Fed. The market's not going down because of the Fed is the phrase we prefer to use. In other words, the Fed was able to bring stability into the system. They were able to unlock the freeze that occurred in credit markets in the month of March. So if a company needs capital, they deserve access to capital, they can gain access to that capital so that they can continue to function as a normal business. And the downside to that is even some bad businesses are gaining access to capital. But the more important point here is that the Fed's main objective was to bring stability into the system. What's driving up stock prices for the most part, and obviously there's going to be outliers both on the long side and the short side, but the prime factor that's really driving stock prices are the actual businesses themselves, right? So when we look at Apple, Microsoft, Amazon, these types of stocks, which we don't even own, by the way, but these types of stocks are near 52-week highs. Meanwhile, the cruise liners, the airliners, the department stores, they're at 52-week lows. So if the Fed was just pushing all stocks up, you wouldn't see that divergence between 52-week highs and 52-week lows. They're simply putting stability into the system so that the market can do its normal job of discriminating between good companies and bad companies and allowing stock pickers to do their job, which is what we try to do on any given day. And so we can see here the Fed has really done a good job in terms of bringing stability into the system. But the other thing is, when the Fed is increasing the size of their balance sheet, we don't want to short the S&P 500. We don't want to short stocks. It's a bad bet. We can see here every time the S&P 500 has had a negative volatility event, the Fed has responded by increasing its overall balance sheet size. And when the Fed responds by expanding its balance sheet size, we can see historically. So what we did here is we looked at a couple studies that looked at when the Fed expands its balance sheet due to a stock market response of plus or minus 10%, usually minus 10% shock to the downside, what has been the forward response of the S&P 500? And we can see here the S&P 500 typically responds positively and with a great deal of stability after the Fed responds by expanding its balance sheet. So the bottom line message between all these charts here is that whenever the S&P 500 is a negative volatility event, the Fed comes in, introduces liquidity and cheap money into the system. It puts a floor on stock prices and then eventually allows for good businesses to get the valuations they deserve that are not getting discounted due to the panic in the market. And therefore, we don't want to try and short into these increasingly powerful tailwinds that the Fed has introduced into the system. These are important charts to look at. These are important charts to remember when you hear all of the headlines, negative headlines in the media that really don't have a lot of substance but scare us, such as the election, such as COVID. We want to make sure we're paying attention to the factors that actually drive long-term stock prices. And we can see what the Fed balance sheet has done here. The growth of M2 money supply, increasingly parabolic through the roof, and that has been a factor of the fact that the Federal Reserve has increased the overall size of its balance sheet. So when you get balance sheet expansion, it leads to a rising supply of cheap money, and historically speaking, we put question marks there, but historically speaking, that means that stock prices do tend to react quite favorably to these actions by the Federal Reserve. That's where we come in and say, okay, we want to make sure we're focusing client assets on the companies that are already in great shape and are going to be able to go on offense thanks to these actions. The other thing we want to remind clients on is that financial repression continues to take hold. So we can see here the 10-year yield now is at 0.54%. But notice what's happening here with inflationary expectations that are sort of 10 years out. The 10-year break-even inflation rate, the red line here, is actually starting to increase. In other words, it's very strange where yields go down and break-evens go the other way. And what's happening as a result, and you see this with the black line here on the chart on the right, is that the real yield for the Treasury market has gone almost to minus 1%. In other words, this 0.54% that you're getting on the 10-year yield is almost a full point below both realized and expected inflationary conditions. And we talked about this a lot over the last couple of months, that we're likely to see the rise of financial repression where the U.S. government pins long-term interest rates below the rate of inflation to inflate away its debt. What does that mean for you, the client, as an investor? That means we have to realize growth we have to offset the savings tax that this ultimately represents by targeting long-term growth through stocks. That's really what we have to do because the bond market is acting as a tax. We have to shift money for that money that we're not going to use for the next 4 years or beyond. We need to shift that money into something that represents a growth vehicle, in this case stocks, where we can target long-term capital appreciation. Now, real quick here in terms of the volatility market, we talked about this last week. The VIX, which stands for volatility, the VIX broke down underneath that critical 26 level. And so what this really means is here on the spot market, which means here today, volatility continues to fall, and that is serving as sort of gasoline that drives stock prices higher. But there's still a lot of angst underneath the surface, and we can see that here with the date of the election, where in the future, so if you look at the VIX curve, volatility prices are expected to be higher around the election. But what that actually tells us is that it's somewhat priced into the market. The market knows it's there. There's an event there that could lead to some rising volatility, and so we need to be aware of that. What's interesting, though, is that over the last week, this has sort of ticked downward a little bit. So we're going to continue to watch that. I would be more concerned about sort of further out in 2021, because at some point we're going to start to go over year-over-year comparisons on inflation. And if inflation sees a big, strong upward tick, that's where the Federal Reserve could come in there and surprise the markets with being a little bit more hawkish on interest rates. We're not even close to that point yet. Well, we're just trying to come up with some different hypotheses of what could drive markets lower in 2021. That's one thing that we're watching, and that's one thing that no one's talking about. And that's always the risk that concerns us the most, the risk that no one's talking about, not the risk that everyone's talking about, such as the election. And then lastly, the credit markets look great. They continue to heal. Credit spreads continue to come in, which is a function of lower credit risk. So both on investment grade and high yield, both those credit spreads are continue to tighten. That's what we want to see. That serves as the foundation for a healthy stock market. And so we're happy to see that as well. So overall, cheap liquidity, negative real rates tend to be historically positive for stocks. Don't fight the Fed. Don't make this more complicated than it needs to be. And when you get falling correlations in the stock market, that makes stock picking critical. We hope that our clients see that the value that we're delivering here year to date. We expect that to continue, obviously, especially since the credit markets are continuing to heal. So if anyone has any questions whatsoever, give us a call. Ask any questions that you need. We want to make sure that you're comfortable. We know that over the next few months there is some uncertainty there, but our businesses are clicking along nicely. Earnings are coming in solid, and we have a high level of confidence here over the next 12 to 24 months. So again, thank you for all of your business. None of this is possible without all of our advisor and client partners. Have a great week, and we'll speak to you again next week. Thank you.